In 2007, Jeff Bezos paid $0 in federal income tax. Not a few thousand, not a reduced rate. Zero. He did it again in 2011. In 2018, Elon Musk, then one of the two richest people on the planet, paid nothing either. Michael Bloomberg paid zero multiple times. George Soros, 0 3 years in a row. This isn't tax evasion. Nobody went to prison. Every one of them, when asked, said the same thing. They paid exactly what the law required. Which is the point. If you're new here, this channel covers how money and power actually work, not how they're supposed to. Hit subscribe so you don't miss what's coming. Now let's get into it. In 2021, the investigative outlet ProPublica published something that had never happened before. Actual IRS data on the tax returns of thousands of America's wealthiest people. 15 years of records. The findings were simple and stunning. Between 2014 and 2018, the top 25 wealthiest Americans saw their fortunes grow by $401 billion. They paid $13.6 billion in federal income taxes, a rate of 3.4%. The average American worker paid more. The question isn't whether this is fair. That's a separate argument. The question is, how does it work? Because once you understand the mechanics, you'll see this isn't a bug. It's a feature. 3 words long. Buy, borrow, die. Before we get into the strategy, you need to understand how ordinary income works, because the system is built on a distinction most people never think about. When you earn a salary, the IRS sees it immediately. Your employer withholds taxes before you even touch the money. By the time your paycheck arrives, the government has already taken its share. You never had a choice. That's how wage income works for most of the country, and it has worked that way since the federal income tax was introduced in 1913. But wealth doesn't work that way. If you own $10 billion worth of Amazon stock, that $10 billion doesn't appear on a tax return. It isn't income. It's an asset. And under U.S. tax law, you only owe tax on an asset when you sell it, which is called a realization event. Until that moment, no matter how much the value grows, no taxes are owed. The government sees nothing. The IRS collects nothing. The wealth just sits there, compounding, untouched. This distinction between income and wealth, between what you earn and what you own, is the foundation everything else is built on. And it didn't happen by accident. When Congress designed the modern tax code, it made a deliberate choice. Tax flows of money, not stocks of it. Tax the paycheck, not the portfolio. The argument at the time was practical, that it's hard to tax something you haven't sold yet. You might not have the cash to pay. But the effect, a century later, is a system where the primary way that rich people get richer, asset appreciation, is almost entirely invisible to the IRS until the moment they choose to make it visible. The system taxes what you earn. It does not tax what you accumulate. And for people whose wealth grows by billions every year without them lifting a finger, that distinction is worth more than any accountant's trick. The richest people in America don't mostly live off salaries. In 2018, the ProPublica data showed the top 25 wealthiest Americans reported a combined $158 million in wages to the IRS, just 1.1% of their total reported incomes. Their real wealth was sitting in stock portfolios, real estate, and private companies, all appreciating, none of it taxed. So the question became, how do you live on billions of dollars without ever selling? Level 1. Buy. The first step is the simplest. You buy assets that go up, stocks, real estate, stakes in private companies, things that compound over time and generate wealth without producing income you'd have to report. Warren Buffett built the entire Berkshire Hathaway structure around this principle. Berkshire doesn't pay dividends. That means Buffett's stake, which has grown into one of the largest private fortunes in history, has never generated regular taxable income for him. His wealth grows entirely through the rising value of his stock, which he holds and doesn't sell. Between 2015 and 2018, Buffett reported taxable income ranging from $11.6 to $25 million per year. At least 14,000 ordinary U.S. taxpayers reported higher income than him in 2015. A man worth over $100 billion, and 14,000 regular Americans out-earned him on paper. That's not a coincidence. That's the design. And Buffett isn't unique. Mark Zuckerberg took a salary of $1 per year for years, while his net worth climbed into the hundreds of billions. Jeff Bezos structured Amazon the same way Buffett structured Berkshire, no dividends, meaning his stake grew entirely through share price appreciation rather than any income the IRS could see in real time. The pattern across the ultra-wealthy is remarkably consistent. Minimize taxable income, maximize asset accumulation, and let the gap between the two numbers grow as wide as possible. The longer you hold, the more that gap widens. Every year Buffett doesn't sell is another year the IRS sees nothing. The asset appreciates, the tax bill stays at zero, and the distance between what he's worth and what the government knows about keeps growing. Level 2. Borrow. Here's where it gets interesting. You've accumulated billions in stock. You haven't sold, but you still need to pay for things. Houses, private jets, funding new ventures. How? You borrow. When Elon Musk wanted to buy Twitter in 2022, he didn't have $44 billion in cash sitting around. Most of his wealth was tied up in Tesla and SpaceX shares. So he arranged something that by now is standard operating procedure for the ultra-wealthy. He pledged his stock as collateral and took out loans against it. By late 2021, Musk had pledged roughly 36% of all his Tesla shares, worth over $100 billion at the time, as collateral against lines of credit. Banks were willing to lend him $12.5 billion secured by $62.5 billion of Tesla stock. He accessed money without selling a single share. This is the engine of buy, borrow, die. And here's the critical detail. Loan proceeds are not income. When a bank hands you $500 million, the IRS doesn't touch it. It's debt, not earnings. You owe it back with interest, but that interest rate is almost always lower than the capital gains tax you'd have owed if you'd sold the stock instead. Think about what that means. You hold $10 billion in stock. You need $300 million. If you sold stock to raise it, you'd owe 20% capital gains tax, a $60 million bill, gone immediately. If instead you borrow against the stock, you pay maybe 3 to 5% interest per year on the loan. Not only is that cheaper, but your stock keeps appreciating while you're spending borrowed money. The strategy is compounding in your favor in two directions at once. This isn't exotic or unusual. Securities-backed loans are standard products at every major bank. Morgan Stanley offers them. Goldman Sachs offers them. The market for these loans reached roughly $138 billion in outstanding balances by early 2024. And research from the Bipartisan Policy Center found they are overwhelmingly held by high-net-worth individuals. The infrastructure exists precisely because the demand exists. And the demand exists precisely because borrowing is cheaper than selling when your assets keep going up. Think about what the bank gets out of this arrangement, too. They're holding $62.5 billion of Tesla stock as security against a $12.5 billion loan. That's an 80% cushion. If Musk defaults, they sell the stock and recover everything. For the bank, it's one of the safest loans they can make. For Musk, it's access to hundreds of millions of dollars with no tax consequence whatsoever. Both sides win, except the IRS. Level 3, die. The final piece is the most elegant and the most consequential. Every loan eventually comes due. If you've borrowed $300 million against your stock portfolio, at some point you have to pay it back. For most borrowers, that means selling assets, which triggers a tax event. But there's one way out of that equation entirely. You die. Under U.S. tax law, specifically 26 U.S. Code 1014, which has been in the tax code since 1921, when someone inherits an asset, its cost basis resets to the fair market value on the date of death. Here's what that means in practice. Say you bought Amazon stock in 1997 for $2,000. By the time you die, that stake is worth $2 million. Normally, if you'd sold it, you'd owe capital gains tax on that $1,998,000 profit, potentially $400,000 or more. But your heirs don't inherit your tax liability. They inherit the stock at today's value, $2 million. As far as the IRS is concerned, the clock starts from the moment they receive it. If they sell the next day for $2 million, they own nothing. Decades of compounding gains, completely erased from the tax record. The estate uses the inherited assets to pay off any outstanding loans. The loans disappear, the gains disappear, and the wealth transfers to the next generation, substantially intact. This is why the Joint Committee on Taxation calculated that the stepped-up basis alone will cost the federal government $72.5 billion in foregone revenue in 2026, roughly a quarter of everything the U.S. collects in capital gains taxes. That's not money that was dodged or hidden, it's money the tax code explicitly decided not to collect, and it has been making that decision every single year since 1921. Now, here's where it gets complicated, because some economists argue the borrowing part of this story is overstated. A 2026 analysis from the Tax Policy Center found that most billionaires actually earn substantial taxable income and reduce their bill through deductions and losses rather than living off loans. The real engine in their view is simpler. Unrealized gains that just never get sold. Wealth compounding inside portfolios that never trigger a taxable event. Both things can be true. The mechanism differs. The outcome is the same. The ProPublica data showed Warren Buffett paid a true tax rate, taxes paid versus wealth gained, of 0.1% between 2014 and 2018. Not 10%, not even 1%. 10 cents for every $100 his fortune grew. Buffett himself acknowledged the paradox. There's been class warfare going on for the last 20 years, he said in 2011, and my class is one. None of this requires offshore accounts or a shady advisor. The stepped-up basis rule has been in the tax code since 1921. The principle that borrowed money isn't income is the foundation of standard lending law. These aren't loopholes in the sense of unintended gaps. They are the system working as designed for people with enough assets to use them. The question worth sitting with isn't whether this is legal. It clearly is. The question is who the tax code was built around. A nurse pays income tax on every paycheck, automatically before she ever sees the money. A billionaire can accumulate $24 billion in wealth over 4 years and pay $23.7 million in taxes, a rate her accountant would find difficult to believe. Both are following the same rulebook. They're just not playing the same game. The buy, borrow, die strategy isn't going away. Proposals to tax unrealized gains or close the stepped-up basis rule have surfaced repeatedly in Congress and failed just as repeatedly. In 2021, Senator Ron Wyden proposed what he called the Billionaires' income tax, a system that would tax the wealthiest Americans on asset gains every single year, whether they sold or not. It applied to anyone with over $1 billion in assets or $100 million in annual income for 3 consecutive years, roughly 700 people. It never made it into law. Key votes in the Senate wouldn't support it, and House Democrats raised concerns about complexity. President Biden tried a different approach, proposing a 25% minimum tax on households worth over $100 million, targeting unrealized gains directly. It appeared in his budget proposals every year from 2022 onward. It never passed either. The moment it was announced, opponents called it unconstitutional, unworkable, a threat to investment. It died in Congress without ever reaching a vote. Every time reform gets close, the same arguments surface. Too complex to administer, too risky for markets, unfair to tax gains that haven't been realized yet. What those arguments don't address is the other side of the ledger. Closing the stepped-up basis alone would raise over $500 billion over a decade, according to congressional estimates. That's not a rounding error. That's a choice, made and remade every year to leave that money on the table. The political math is complicated, partly because the people who benefit from these rules are also among the most politically connected in the country. The same billionaires who benefit from buy, borrow, die are often the largest donors to the campaigns of the lawmakers who vote on whether to change it. What's changed is that the mechanics are now public. The ProPublicophiles put actual numbers to what had previously been assumed. Ordinary people can now see, in black and white, that the wealthiest Americans paid a true tax rate of 3.4% on wealth that grew by $401 billion. And now that the machinery is visible, the conversation about whether it should work this way is at least happening with real data. Whether that leads anywhere is a different question. If this video made something click for you, share it with someone who thinks the rich just work harder. And if you're not subscribed yet, now's the time. There's a lot more where this came from. Some people argue these strategies are perfectly rational tax planning. The code is the code, and anyone with the means would use it. Others say a system where a billionaire's true tax rate is 0.1% while a nurse pays 20% isn't working as intended. It's working as captured. Where do you land on that?